Welcome everyone to another deep dive. Today, we have a really fascinating, highly actionable mission for you.
Yeah, we are getting into some wild stuff today.
We really are. We are looking at the Q2 2026 earnings call for Invitation Homes, ticker symbol INVH.
Right, the absolute giant in the single-family rental space.
Exactly. And for this specific deep dive, we are adopting a structured framework to really translate the dense Wall Street jargon into clear takeaways for you, the everyday retail investor.
Which is so necessary with real estate earnings, honestly.
Oh, absolutely. So we're going to move through 4 distinct phases today. We'll start with the headline numbers, then we'll get into the story behind the numbers, management's forward guidance, and finally, the bottom line.
The bullish or bearish verdict.
Right. And to tease what is coming up, there is a fascinating capital allocation strategy happening behind the scenes here. Okay. INVH is effectively buying houses for like $270,000. They're actually worth $450,000 on the open market.
Yeah, it's an incredible capital arbitrage.
It really is. And they are doing it simply by manipulating their own stock. But before we get to the magic tricks, let's start with phase 1. The headline numbers.
Let's do it. So kicking off with the hard data from the print. The Q2 2026 core FFO, which is funds from operations, came in at 51 cents per share.
Okay, 51 cents.
Yeah, which is up 5% year over year. And then their AFFO, or adjusted funds from operations, that hit 44 cents per share.
Up nearly 6%.
Yeah, exactly. Up almost 6%.
Wait, hold on. Let me just stop you there because we need to banish the jargon for a second. If you usually invest in, I don't know, tech stocks or banks, you are probably wondering why we aren't talking about EPS right now, earnings per share.
Oh, yeah, the GAAP accounting trap.
Right. So for the listener, in real estate, EPS is basically a useless metric. I like to use an analogy here. Looking at FFO is like looking at the actual cash inside the cash register at the end of the day.
Which is what actually matters.
Exactly. But GAAP accounting forces real estate owners to pretend their properties are wasting away. Like if you bought a house in Atlanta 10 years ago, standard accounting makes you apply this massive paper depreciation charge against the revenue.
Yeah, they treat a brick house like it's a piece of software going obsolete, which is, well, it's just not reality.
Right. It artificially makes real estate earnings look incredibly low. So FFO strips out that paper illusion. It adds the depreciation back to show you the real cash.
And then AFFO takes it even one step further by subtracting the recurring capital expenditures. So like replacing a blown HVAC or putting on a new roof.
The real maintenance cash.
Right. So seeing both of those pure cash flow metrics up 5 to 6%, I mean, that signals a really strong underlying business. But to understand why, we have to look at the property level operating metrics.
Right. The day-to-day operations. What did the same store NOI look like?
So same store net operating income, which, only looks at the houses they owned a year ago, so we get a clean comparison, that grew 1.5% year over year.
Okay, 1.5%? That doesn't sound massive on the surface.
Well, it's the composition of that number that is the real story here. That growth was driven by 1.6% revenue growth, but they managed to keep their core operating expense growth to an incredibly tight 1.9%.
Wow. Under 2% expense growth right now.
Yeah, which is a massive operational flex. You have to remember, managing 80,000 scattered site single-family homes is just a logistical nightmare.
Because they aren't all in one building.
Exactly. It's not a multi-family high-rise where the maintenance guy can just take the elevator to fix 5 different toilets before lunch.
Right, he's got to drive across town.
Yeah, massive windshield time. Complex vendor routing across 16 different geographic markets. So keeping expense growth that low in an environment where, labor and materials are still highly inflated, it requires immense scale.
And the breakdown of those expenses is super interesting too. Management essentially split the ledger into fixed costs and controllable costs on the call.
Right, the stuff they can't control versus what they can.
Exactly. So the fixed costs, which is mostly property taxes and insurance, those jumped 3.5% year over year. I mean, INVH can't negotiate with a county tax assessor.
No, definitely not.
And they can't negotiate with the actuaries pricing in hurricane risk down in Florida either.
Right. Florida insurance is just brutal right now.
It really is. But the controllables, the daily costs of turning over a house, preventative maintenance, landscaping, those controllables were actually down 1% year over year.
Which is just wild. Shrinking daily operating costs right now points to highly, highly optimized internal systems.
How are they actually doing that, though?
Well, they've aggressively internalized their property management. They pull away from third-party vendors. When you have enough density in a market, like in the Carolinas or Southern California, you just hire in-house technicians.
So they don't have to pay the vendor markup.
Right, and they route them using this proprietary logistics software to minimize the drive time. Plus, they're buying materials directly from manufacturers in massive bulk.
Like thousands of water heaters at a time.
Exactly, and they also deploy smart home tech.
Right.
Water leak sensors, smart thermostats. It's predictive maintenance. So you stop a $50 plumbing drip before it becomes like a $5,000 catastrophic drywall repair.
Right. That makes total sense. But of course, tight expense control only matters if the houses are actually generating revenue.
Ugh.
And looking at the occupancy numbers, these homes are packed.
Oh, completely packed.
They held a 97.1% occupancy rate through the end of June. And you have to understand, June is the absolute peak of the summer leasing season.
Yeah, turnover is usually the highest right then.
Right, because the core renter for a 3-bedroom house is a family with kids. And families move in the summer, so they don't mess up the school year. So holding above 97% during the craziest turnover period means they're moving one family out, fixing the place up, and moving the next family in with almost zero downtime.
Yeah, the turnover rate actually dropped by 50 basis points to 5.7%, which is crucial because every single day a property sits empty, that is unrecoverable lost yield. You never get that rent back.
Never.
But the pricing power attached to those occupied homes, this is where we start seeing a big fracture in the broader consumer economy.
Let's talk about the lease rate growth, because this was striking.
Yeah, the blended lease rate growth was 2.7% for the quarter. But the split inside that blend is stark.
Right. New leases versus renewals.
Exactly. New lease growth was barely positive, just 1.1%. But renewal growth was extremely robust at 3.3%, and it was accelerating into the end of the quarter.
You know, that divergence might be the single most important macroeconomic indicator in this entire deep dive.
I completely agree.
Because when new leases are only budging 1%, it tells you the open market is hesitant. To get a totally new tenant off the street, INVH has to price really competitively.
They're fighting against, multifamily supply or just general consumer belt tightening.
Right. But a 3.3% renewal rate means the existing tenants are just absorbing the rent hikes and staying put. To me, that says tenants feel somewhat trapped.
Absolutely.
They aren't staying because they love the standard issue carpet. They are staying because the alternative is financially impossible, which naturally transitions us into phase 2, the story behind the numbers.
The affordability gap.
Exactly. The sheer difference between leasing and buying right now. There was a staggering statistic on the call about this.
Yeah, management cited data from John Burns Real Estate Consulting. Basically, on average, across all their markets, it is over $1,000 per month cheaper to lease an Invitation Homes property than to own a comparable house.
$1,000 a month. That is massive.
It's totally inverted the traditional American dream math. The old idea that renting is just throwing money away.
Well, the math on homeownership right now is just a toxic cocktail. If one of their tenants wants to move out and buy a similar $450,000 house in the exact same school district, first, they need a huge down payment.
Which nobody has in cash right now.
Right. Then they're taking on a mortgage at, 7%? So the principal and interest alone is astronomical compared to the 3% era just a few years ago.
Plus, you stack on elevated property taxes because home values are inflated. And homeowners insurance, which has doubled in states like Florida.
And maintenance costs. If the HVAC blows when you own the house, you can't just call the INVH maintenance guy.
Right, you're paying inflated labor rates out of pocket. So when you bake the true cost of ownership into a monthly payment, buying a starter home today is just punishing.
And INVH is offering the exact same physical utility a house in a good neighborhood for $1,000 less a month. So naturally, resident behavior is changing.
Yeah, the average resident tenure is now over 40 months.
Wow, over 3 years.
Yeah, and if you think about it, saving $1,000 a month for 40 months, that is $40,000 in retained cash flow for that family compared to buying.
Which gives the company immense psychological leverage. Imagine a family gets their lease renewal. Rent is up 3.3%. They might get mad, open Zillow, run a mortgage calculator at 7%, and instantly realize moving would destroy their finances.
Exactly. So they sign the renewal. The demand is structurally sticky because the escape valve homeownership is basically welded shut right now.
It is welded shut. Okay, so that sticky demand secures the cash flow. But I want to talk about the masterclass in capital recycling that management is doing, because this is where the real value is created.
Oh, the stock buybacks. This is the arbitrage we teased earlier.
Yes. It seems like a contradiction, right? INVH is a real estate company, but instead of buying new properties, they are aggressively buying their own stock. Break down this arbitrage for us.
Okay, so INVH bought back $100 million of their own stock in Q2. And since December, they've bought back roughly $600 million total.
That is a lot of capital.
It is. And the average execution price was $26.30 per share. Now, if you take that stock price, factor in the debt, and divide it by their total properties, the implied value of their wholly owned homes is just over $270,000 per house.
Okay, wait. So Wall Street is saying, based on the stock price, each house is worth $270,000.
Exactly. But meanwhile, in the real world, INVH sold 657 actual physical homes in Q2. And the average price they got for those homes from regular buyers was $450,000.
That is just incredible.
It's a massive premium. They are liquidating physical homes at retail prices to families, taking that exact cash and using it to buy back their own stock at a massive wholesale discount.
It's like buying a fully assembled car from a dealership for 15 grand, taking it apart and selling the parts for 30 grand.
That's exactly what it is. And doing this requires immense discipline. Most real estate executives just want to build empires. They want to say, look, we own 100,000 homes, even if they overpay for them.
Just to show top-line growth.
Right. But INVH is acting like capital allocators first. If Wall Street won't value the real estate correctly, they will shrink their physical footprint to grow the per-share value.
Because with fewer shares outstanding, every remaining share claims a bigger piece of the rental cash flow.
Precisely. It instantly creates immense shareholder value.
Okay, but they can't shrink forever, right? Eventually, a real estate company does need to grow its actual housing supply, which brings up the regulatory backdrop, because there was a major roadblock mentioned on the call.
Yeah, the 21st Century Road to Housing Act.
Right. Can you explain what happened there? Because it sounds like it caused a major freeze in the market.
It did. Whenever you have sweeping federal housing legislation being debated, institutional capital just stops moving. Because underwriters can't model returns if the rules might change next month. Are there going to be rent caps, punitive taxes?
So they just hit pause on everything.
Total deep freeze. For 6 months, regional operators stopped selling portfolios, and crucially, INVH's development pipeline got delayed.
This is Resabilt, right? Their in-house developer.
Right. Resabilt builds purpose-built rental neighborhoods from the dirt up. But with the legislative freeze, land carry costs accumulated, municipal permits were at risk, and contractors started moving to other projects.
That sounds pretty painful.
It was a drag. But, and this is the key update from the call, the act has now been officially enacted. The uncertainty is gone. And the CEO, Dallas Tanner, noted that the final language actually streamlines zoning for purpose-built rentals.
Oh, so it actually helps them in the long run.
Exactly. And now that the rules are clear, the institutional market is rapidly thawing. Capital is flowing again. Smaller 50 to 100 home portfolios are up for grabs again.
Which naturally leads us right into phase 3 of our deep dive, management guidance. Because if capital is flowing again, how does management view the rest of the year?
They are very, very optimistic. They aggressively raise their full-year guidance.
A mid-year raise is always a massive signal of confidence. What are the new numbers?
They raised their full-year core FFO midpoint to $1.95 and their AFFO to $1.65.
Okay, so profit expectations are up.
Yep. But the most aggressive revision was their disposition guidance, the amount of homes they plan to sell. They increased that target by $300 million.
Wait, $300 million? That's a huge jump.
It brings the total planned sales for the year to $850 million.
I see what's happening. They're leaning heavily into that capital arbitrage strategy we just talked about.
Exactly. They know the private market will pay top dollar for physical homes right now, so they're aggressively liquidating older or lower-yielding homes to build a massive cash war chest.
And they shared some real-time July data on the call to back this up, didn't they?
They did, and the July numbers were phenomenal. Blended lease growth accelerated to 3.4%.
Up from 2.7 in Q2.
Right. And renewals in July jumped to a massive 4.3%. So that stickiness we saw in the spring, it's only getting stronger in the late summer.
And occupancy.
Occupancy held strong at 96.5%. which, yes, is slightly lower than the Q2 average, but perfectly normal for seasonal move-outs in July.
Right. Maintaining mid-90s occupancy while pushing rents up over 4% is just an absolute flex of pricing power. But, I have to push back here.
I figured you would.
Everything sounds flawless, but real estate at this scale always has friction. Guidance is up, but what are the executives actually worried about behind closed doors for the second half of the year?
So management flagged two specific execution risks. First is the lingering drag from those res-a-built delays.
Right, because of the legislative freeze.
Yeah, a 6-month delay in breaking ground means a 6-month delay in cash flow. So the earnings contribution from those new developments is going to come in slightly behind their original models for 2026.
Okay, that makes sense. Time is money in development. What's the second risk?
The second and much bigger headwind is property taxes. It's a huge black box right now.
Why is it a black box? So don't they know what their taxes are?
Not yet. The timing of municipal assessments creates this weird mismatch. Property taxes make up 55% of INVH's total operating expenses.
Wow, over half their expenses.
Yeah. And 70% of that tax bill comes from just 3 states: California, Georgia, and Florida. But the actual assessed values and the tax bills from places like Fulton County in Georgia or Miami-Dade in Florida, they don't crystallize until the fall.
Oh, I see. So right now they're just guessing based on projections.
Exactly. If a county decides to aggressively true up their assessments to capture the crazy property value spikes from the last couple of years, those bills could be way higher than expected.
And if that tax line item surges in Q4, that beautiful 1.9% expense control they bragged about will just evaporate.
Right. It's the inherent risk of owning assets in high-growth Sunbelt markets. The local governments view institutional real estate as a piggy bank to fund their infrastructure.
So with unpredictable local taxes looming, the only real defense is a bulletproof balance sheet, which they definitely seem to have. Let's talk about their debt, because they just made a major move.
Yeah, they opportunistically issued $500 million in unsecured senior notes right after the quarter closed, maturing in 2032.
And what was the interest rate on that?
Exactly 4.95%.
Wait, sub 5% debt right now.
I know. When the 10-year treasury is bouncing all over the place, securing sub 5% unsecured debt is a huge testament to how much the bond market trusts their cash flows.
Unsecured meaning it isn't tied to specific houses, right?
Right. It's backed by the whole corporation. And they immediately use that cheap capital to prepay roughly half of an older $988 million securitization from 2017 that was coming due next year.
So they basically cleared their only major near-term debt hurdle.
Exactly. Push the liabilities out, locked in fixed costs. It keeps their net debt to EBITDA ratio at 5.4 times, which is actually below their target range.
They have $1.5 billion in liquidity too.
Yeah.
But the stat that jumped out to me on the balance sheet was about their unencumbered homes.
Oh, yeah. This is crucial. Approximately 90% of their wholly owned homes are completely unencumbered.
Meaning they don't have a mortgage attached to them.
Right. When properties are tied up in a commercial mortgage-backed security, a CMBS, the rules are incredibly restrictive. You can't just sell a home out of a CMBS without paying huge penalties and dealing with special servicers.
It's a total headache.
But because INVH relies on corporate-level debt, they own 90% of their houses free and clear. If they want to sell 500 homes in Atlanta tomorrow to fund a stock buyback, they can just do it instantly. No lender permission required.
Which brings us perfectly to phase 4, the bottom line. Having weighed the macro tailwinds against the localized headwinds, it's time to synthesize this. For the retail investor holding or considering INVH, is this a bullish or bearish signal?
For me, it is definitively bullish. INVH is operating from a position of absolute power right now.
Explain that. Why absolute power?
Because weakness in real estate usually looks like desperation. Companies forced to issue equity to cover bad debt or forced to buy overpriced homes just to show growth to analysts. INVH isn't forced to do anything.
They can just sit back and optimize.
Exactly. They are highly disciplined capital allocators. They're harvesting physical real estate gains, controlling their daily expenses, and utilizing a brilliant multi-lever compounding strategy.
And they have that construction lending pipeline too, which we haven't even touched on yet.
Oh, the $350 million lending pipeline. This is so smart.
Break that down for the listener. How does that work?
So while the legislative freeze halted them from buying outright, INVH stepped in as a lender. Traditional banks are terrified of commercial real estate right now, so INVH is providing the debt to regional builders who are developing rental communities.
So they are acting as the bank. What kind of yield are they getting?
They're getting like 8 or 9% yield on the capital. But the interest income isn't even the main point. The real advantage is pipeline control.
By funding the builder, they get first dibs on the neighborhood when it's done.
Right. They secure the right of first refusal, so they get paid a high yield to just wait for the exact brand new inventory they want to own, totally avoiding the headache of actually building it themselves.
That is just a well-oiled machine. So to translate all this into an actionable takeaway for you, the listener, Invitation Homes is essentially a capital compounding machine operating in an environment with structurally constrained housing supply and highly sticky rental demand.
They don't need to buy thousands of homes at a 7% cost of capital to grow. They just optimize the cash flows they already have and shrink the equity base.
It's the triumph of capital efficiency. Disciplined expense control and smart capital recycling yielding massive results.
It really is. The single-family rental market has completely evolved from a mom-and-pop industry into a highly sophisticated asset class.
Okay, as we close out this deep dive, I want to leave you with a final thought to mull over. We've talked a lot about the numbers, the arbitrage, the $450,000 homes.
But there is a bigger cultural question here.
Exactly. With renting currently saving families roughly $40,000 over a standard lease tenure compared to buying, are we witnessing a permanent cultural shift?
It's a huge question. Is the traditional American dream of home ownership slowly being replaced by the financial pragmatism of home leasing?
Right. Because if the macro environment dictates that renting is just mathematically superior for cash flow, the cultural prestige of owning a home might just erode. And the institutions controlling that lease supply, well, they're positioning themselves at the absolute center of that new reality. Something for you to consider as you look at the landscape of real estate investing going forward. Definitely something to watch. All right, that wraps up our analysis of INVH for today. Thank you for joining us on this deep dive, and we'll catch you next time.